Welcome back to What's Hot, What's Not, CRE. It's Wednesday, March 4th, 2026. Today we're diving deep into the number one topic on every investor's mind, the 10-year Treasury. What are rates telling us, and how is it impacting commercial real estate right now? Let's get into it. Let's start with what's hot. And the theme today, in one word, is stability. The 10-year Treasury is sitting at 4.09% as of this morning. That's up just a tiny 4 basis points from Monday's 4.05%. We've been trading in a very tight range all week, and frankly, that calm predictability is exactly what the commercial real estate market has been desperate for. This predictability is what unlocks deal flow. For months, buyers and sellers were at a standstill, paralyzed by rate volatility. Now, with a stable benchmark, cap rate spreads are back to attractive levels. We're seeing Class A multifamily and primary markets pricing between 4.5% and 5.25%. Industrial logistics, a healthy 5.5% to 6.25%. Those spreads over treasuries finally make sense again, and transaction velocity is responding. Colliers is forecasting a solid 15 to 20% growth in U.S. CRE investment volume this year. Looking back, we know that through October of 2025, transactions hit $385.7 billion, which was up 13% year over year. The bid-ask spreads have narrowed significantly. Deals are penciling again. The market is even pricing in some mild cap rate compression of 5 to 15 basis points for 2026, especially in high-demand sectors like industrial and multifamily. Now for what's not, and this is a big one. Aggressive rate cut hopes. The Fed held the line in January, keeping rates at 3.5% to 3.75%. And as we look ahead to the March FOMC meeting, the market is pricing in a 97% probability of no change. Why? Inflation remains sticky, hovering near 3%, still stubbornly above the Fed's 2% target. The bond market is sending a very clear signal here. Do not underwrite deals based on the hope of significant rate relief. Even if the Fed does enact a few small cuts later this year, it's unlikely we'll see long-term yields drop below 3.75%. The Congressional Budget Office projects the 10-year will be right around 3.95% by the end of this quarter. That is not a dramatic downward move. So, why it matters? The waiting game is over. For the better part of 2 years, the industry mantra was, wait for the pivot. Well, the pivot came and went, and this is the new reality. Deals getting done today work at current rates, not on the hope of future cuts. We're seeing capital deploy with confidence into assets with durable income streams. Think value-add multifamily, industrial, and grocery-anchored retail. These deals work regardless of the Fed's next move. Another key point is that the yield curve is likely to stay steep. Ongoing Treasury supply and large fiscal deficits are putting structural upward pressure on long-term yields. This isn't a temporary blip. It's a feature of the current economic landscape, which brings us to the investor takeaway. Stability in that 4 to 4.25% range for the 10-year is the new sweet spot. It's not the low rates of the past, but it's predictable, and that's what unlocks transaction activity. My advice? Underwrite conservatively at current rates. Do not bet on rate cuts to make your deal work. Focus on the fundamentals that you can control. Occupancy, rent growth, and a healthy cap rate spread. In 2026, that's what will truly drive returns. Thanks for tuning in to What's Hot, What's Not, CRE. Don't forget to like, share, and subscribe for your daily dose of market intelligence. And for more insights, visit hotnotcre.com to subscribe to our newsletter.